Dr. Cheryl Dunn. I'm here today to demonstrate an introductory financial accounting problem about inventory turnover and days sales in inventory. Take a look at the problem for HornetGreen, Inc. Inventory turnover represents how many times the company has on average completely sold its inventory during a time period. The formula is cost of goods sold divided by average inventory. Because this ratio uses an income statement number, cost of goods sold, and a balance sheet number, inventory, we have to average the balance sheet number because they have different time periods associated with them. The income statement covers a period of time, whereas the balance sheet is at a point in time. We try to make the balance sheet more like it's covering a period of time by taking the beginning and the ending balances and averaging them. It's not a perfect similarity to the income statement period because the balance at any point during that period for the balance sheet might have been very different from what it was like at the beginning or the end of the accounting period. But it's considered to be better to do this than to take just a single point in time. In this case, average inventory is going to be the beginning balance of $15,800 plus the ending balance of $12,200 divided by 2. And so if we add $15,800 plus $12,200, we have $28,000. And then if we divide that by 2, that gives us $14,000 as our average inventory for this company. So that's the number that we're going to use on the denominator over here. The cost of goods sold that goes in the numerator was given to us as $320,000. And if we divide $14,000 into $320,000, we find that that goes 22.86 times. So this is our inventory turnover. That means that this company sold the equivalent of its average inventory 22.86 times during the year. The higher the inventory turnover, the better the company has done. How good 22.86 times is depends in part on what industry the company is in. Low-cost products such as perishable groceries should turn over a lot faster than high-cost durable products such as appliances. Now the next part of the question asks us to calculate the average days sales in inventory. To calculate that, we assume a 360-day year, and so we simply take the 360 days and we divide it by the inventory turnover of 22.86. When we divide 360 by 22.86, we're going to get 15.75. That's how many days worth of inventory this company has on hand. And that means it takes approximately 15.75 days for the company to sell that average balance of inventory. And again, whether that value is considered good depends in part on what industry the company is in. To have 15.75 days worth of milk on hand would not be all that good, as some of that milk is bound to spoil before it is sold. Thank you for viewing this demonstration. I hope you found it helpful.